You called it back in April, didn't you? The end of the 30-year rally in bonds. Now you're describing the market in military terms, a war in which there will be many casualties. Why do you see it's being so bloody?
Well, it's bloody if, in fact, the market has turned and interest rates have moved higher. And certainly they've done that for the past 3 months, and bond prices have gone down. We all know that bond mutual funds and the market itself is described in, in higher quality terms has slipped by about 2%, and investors are worried. And so, I'm suggesting that there's a war on to retain assets to fight a future battle in which the return on bonds may be less than historic. And so we've come up with some strategies that aren't necessarily duration or maturity related and that can protect principal more than historic.
Usually when I think of war, I think of fighting the Fed, and that has certainly been the mantra over the past few years. That has been the regime. Now we're talking about tapering in September. Is September the time, and does this mean that that whole regime changes?
I think it is changing, Sarah. I think September is probably the time. We'd give it 80%, and here's the reasoning behind that. We think that future Fed policy will increasingly rely on what is now being called forward guidance as opposed to asset purchases or quantitative easing. Quantitative easing, to our way of thinking, I think to the Fed's way of thinking, is a tired horse which has inflated asset prices but done little to stimulate real growth. We're really in a 2% real growth environment still. And in addition to that, according to some Fed governors and some Fed members, it's placed the Fed's balance sheet at future risk according to the potential for higher interest rates. And so this sort of implies to us, a reliance on future guidance, on forward guidance, which is really a reverse type of twist. Remember the twist back in September of 2011? This is a reverse twist in which, the Fed wants the market basically to buy 1 to 5 year securities with the comfort of forward guidance, and they're withdrawing the purchasing of 85% of the gross issuance of 20 to 30 year treasuries. So, the advantage, if this diagnosis is correct, is that long treasuries and long maturities should be sold, and 1 to 5 year, 1 to 10 year maturities should be bought based upon this transition.
Bill, how certain are you right now about the direction of the bond market? And to the degree that you are, beyond what you just told us, how are you expressing that certainty in a way that you believe is going to deliver returns?
The way we look at it, Eric, and it's a conceptual way. It's not subject to historical modeling other from the standpoint of common sense, is that in a highly levered economy, and we have a highly levered economy not just in the U.S. but globally, when there's a lot of leverage in the economy, a central bank must tread lightly in terms of increasing interest rates. That's why we're seeing the emphasis on forward guidance, and that's why we've seen quantitative easing. And so, the historic raising of interest rates to countermand higher inflationary threats, basically is a thing of the past. And so we think the Fed stays where they are at 25 basis points for a long, long time, perhaps 2016 and beyond. What does that mean, though, in terms of strategy? It means that interest rates, it means that the 5 year, it means that the 10 year at basically 260 or 65, they don't represent value relative to inflation, but they represent value relative to, where they were 3 or 4 months ago at 150 or 160. So, it all depends on what the Fed does. It all depends on what the central bank does. It depends upon leverage and the associated increase, which would slow an economy significantly, and we think the Fed, understands that.
I'm glad you brought up inflation, Bill. Where is the inflation, and do you think it's something to be concerned about, this lack of higher prices, both at the producer level, which we saw today, and at the consumer level in an economy that is theoretically recovering?
I think so, and Bernanke has emphasized this, Sarah. He said that they will defend inflation, not from the top side, but from the downside. And, in terms of their particular monitoring, the PCE, the consumption deflator, so to speak, that's really at 1.2%, and they're targeting 2 to as high as 2.5%. So, this would argue for an aggressively easing, an aggressively ease of Fed policy going forward, keeping Fed funds very low in order to elevate inflation, much like the Japanese are trying to do in their particular economy.
Bill, you earlier made reference to a war to retain assets in the fixed income market. In your latest note to clients, you said, trust me, no investment firm has given this transition more thought. The Total Return Fund has suffered some redemptions. Have you reversed the tide? Is it working? And if so, what's working?
Yeah, it sure is working, Eric. Over the past month and a half, our returns relative to the market are not only positive in terms of alpha, but positive in terms of their real returns. So we're moving in the right direction. And what the strategy is basically is to emphasize duration less, emphasize longer maturities less. The problem with that being that you reduce yield. If you, for instance, went to cash entirely, you'd have a portfolio that yielded 10 basis points, and clients really wouldn't want that. So what you want to do is reduce duration, but substitute other areas in the bond market which provide what we call carry. Now, carry is a term which basically emphasizes yield, but yield that is less sensitive to duration. We're talking about credit spreads. We're talking about yield curve emphasis. We're talking about volatility. And we're talking about perhaps bonds and other currencies as opposed to dollar-related currencies. So, there are other ways to defeat this army or this invader other than emphasizing duration, and we intend to move into other areas in order to do it.
Well, let's talk about another area, Bill, that hasn't been too hot lately, but looks like it's turning a corner, and that would be Europe. Expansion in GDP for the euro area. Is it time for you and Pimco to dip back into Europe and start shopping there?
Well, perhaps not. Certainly, perhaps not in the core countries such as Germany. Yields are historically low, lower even than in the United States. And so if Europe and Euroland is improving, then, you wouldn't look for the ECB to begin tightening. They just gave us forward guidance in terms of easing for an indefinite period of time. So, they're under the same terms as the United States, but their yields are, significantly lower, at least in terms of the core. In terms of the UK, they in turn have adopted forward guidance, which suggests, although it's indefinite in terms of the lead and the lag in terms of their unemployment indicator at 7%, their particular policy is as easy as the policy in the United States. So, I might favor the UK. I would look askance perhaps at German bunds.